Ladies and gentlemen, good day and welcome to the Q2 and H1 FY2026 earnings conference call of Laxmi Organic Industries Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. From the management, we have with us Dr. Rajan Venkatesh, MD and CEO, and Mr. Mahadev Karnik, CFO. We will now begin the call with remarks from the management team, followed by a question and answer session. Before we begin, I would like to point out that this conference call may contain certain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company and involve risks and uncertainties that are difficult to predict. I now hand the call to Dr. Rajan Venkatesh, MD and CEO. Thank you, and over to you, sir.
Thank you. So again, namaskaram to one and all. Good morning, good evening, and good afternoon, depending on the time zone that you are dialing into. And also thank you for investing your time with Laxmi today. As we go through the commentary, the topics I would like to cover is just give you just broad strokes or where we are in the chemical industry. The second element is get you slightly closer to home, talk about the markets that we are serving, what are the demand signals from that. Give you quick updates on where we are in our journey across the various verticals, right? So let me start first on the global chemical industry. There the trajectory continues to be shaped by regional dynamics given the supply side overcapacities that we are experiencing. I think many of us who have been tracking the industry, we certainly see there is a lot of targeted efforts towards cost optimization. There's a lot of shutdown and or restructuring of structurally subscale and non-competitive assets. And there are also the conversations around rerouting of supply chain linked to evolving tariffs. So that's the backdrop. So I would say it would be fair to say that the backdrop that we are operating in chemicals was demanding and continues to be demanding. If you then focus on the key segments, while we are serving also other segments, but the key segments that we are currently serving, packaging, inks and adhesives in Q2, the signals that we received was the demand on a quarter-on-quarter basis remained stable. In agro, it is moderate. In paints and coatings, it remains weak to moderate. And in pharmaceutical, it remains stable on a quarter-to-quarter basis. Then coming further down, what we have also done this time around is we have given you some more insights into our investor deck on slide 17, actually calling out how the growth journey has been for our specialty business, which is the ketene diketene. I think it's also an important time given that we are at an interesting cusp of also bringing up the new capacity in the ketene diketene space, and it nicely shows our growth journey over from 2017 onwards, which has been in the range of 18 to 20%. And we today, as we speak, are somewhere having a market share close to about 8-9% in the diketene derivatives space. What is also very important, and I think which is top of your minds and our minds, is our fluorine setup. That is also ramping up according to the plans that we had laid out. That is, we are anticipating to have revenues which is closer to the 40 to 50% of the peak revenues that we had called out in the past. We are also excited, and we've called that out before. The contract with Hitachi Energy has been signed, and this is for the production of an eco-efficient gas used in their SF6 free high voltage switchgear portfolio called Econic, which is trademarked by them. And we have also reaffirming that the capex linked to the same can be accommodated in the previously called out 1,100 crores that we had laid out. Also very exciting for us at our upcoming site at Dahej, around the auspicious period of Diwali, we received the consent to operate from the Gujarat Pollution Control Board for phase 1 of our synthetic organic chemicals manufacturing facility, and we have already started supplying customers from that setup. So focus moving forward also remains to bring the phase 2, to complete the phase 2 and also operationalize the same at the Dahej facility, which we are looking forward to do in the course of the second half, towards the end of the second half of this financial year. And then FY27 would be the steady ramp up that we will expect from that. So then coming again, what is important specifically if you talk about the quarter 2 performance, and I'll call out specialty specifically. We had also called this, explained to the broader community what happened in quarter 1 and why we basically were anticipating quarter 2 to be in a similar ballpark. The 3 primary reasons: one was an anticipated phase out of one agrochemical product for which we supplied the intermediate. Like we called out the last time around, the alternative product is mapped already. The second one is deferred deliveries to global customers, which will now happen in the second half. So in this half of the financial year, between quarter 3 and quarter 4. And what we also have noticed, which we also did call out last time, is market price moderation across the segment. So that's an important element I would like to again restate and park with the whole audience. And also I think what would be interesting for the audience to know is we are currently in a scheduled turnaround at our site 2, that is our specialty ketene diketene setup. And this turnaround is happening as we speak, and we are expected to come out of this turnaround by middle of this month, the middle of November. We are still in October, I forget, by the middle of November. So scheduled turnaround taking place according to time and also expected to start up on that basis. With that, I will pass it across to my colleague Mahadev, who will take you through a little more granularity on the financials.
Yeah, thank you, Rajan. So I will take you through the financials in brief for quarter 2. And we have called it out in quarter 1 that the EBITDA would be in the range of quarter 1, and we are happy to say that we have kind of maintained the same. So on revenue front, our revenue declined by 9%, mainly coming from specialty, which is 20% decline, as Rajan called out. Out of this 20%, 10% was for the anticipated phase out of the product. 7% was the market price moderations, and rest was deferment of the orders to next half. This essential revenue saw a decline of 5%, mainly the price linked to the feedstock. The volumes are in line with last year. In case of gross margin, the gross margin is at 33.1% versus quarter 1 of 30.8%, and versus last year of 35.8%. It's mainly coming because of the product mix versus last year in specialty chemicals business. Our total expenses are declining year on year basis by nearly 5%. That shows that we are having a lot of cost control here. And EBITDA stands at nearly 37 crores versus 74 crores last year. So EBITDA margin profile has gone down from 9.7 to 5.3. Depreciation, because of the change in methodology, has come down from 27 crore to 19 crore. Finance costs remain nearly broadly in the same line. So post that, the PAT has declined from 28 crore to 110 crore. In spite of this, our cash flow from operation remains robust at 153 crores, and our debt to equity ratio is at 1.17, which is very much robust. We will get into the capex cycle and borrowing cycle in H2. and we will be in ballpark of nearly 400 to 500 crores of term loans by H2. So with that, I will leave it to Tanay for further question and answer.
Thank you, sir. You can begin the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Janam Ghelani from Swan Investments. Please go ahead.
Hi, sir. Thanks for this opportunity. So, my first question is, as you mentioned in your opening remarks that we have some deferred shipments for the H2. So, would you be able to quantify as to, in terms of value or volume, that how much would that be?
So, Jaman, thanks again for joining the call. I think we want to be a bit more coy about it. I hope you can understand, because that is, I would say, of a bit of competitive nature. But the call out still remains that we have a phase out of our one agrochemical intermediate. We have an alternative product mapped, and as you heard also from Madhav, when you saw the 20% drop in the specialty element, Madhav, you can give some clarity. But Jim, I would require your respect that we cannot be more granular on that topic. But we can assure that we are also very, very clear with our customers. This is something that will manifest in this second half.
Okay. But sir, would you be able to quantify that? What was the revenue drop due to the product that we lost, the agrochemical product that was break down?
That earlier what we called out was nearly 10% of our specialty business.
Okay. So can we expect that by end of Q4 or so, like by March 26 or Q1 FY27, we can revert back to our margins of specialty in the range of 22 to 25%?
So I think a few things will happen. One is we will have the H setup that we would like to sort of complete mechanical completion by the end of this financial year. So we will have one element as we move into FY27, ramping up from there. And we also, as we have called out, we have an alternative product mapped for this phased out agrochemical intermediate. And I think that both will help us to pivot in the right direction.
Okay. And sir, since you mentioned that there is overcapacity globally for ethyl acetate, are we forcing any global shutdowns in any geography, and whether that could, improve the spreads going ahead?
So I think we've discussed in the past call. So we do see certain capacities coming offline. One specific one was Sitchem in the Middle East, 100,000 ton capacity that has come offline. This is something we called out in the previous quarter. And I think, at the current spreads, we will certainly, in our estimate, continue to see players who are in quarter 2, quarter 3, and even quarter 4 of the cost curve facing the heat. That is our anticipation, but I am not at privy to tell you, how much capacity could come offline.
Okay, sir. So that's it from my side. I'll get back in my side. Thank you.
Thank you.
Thank you. The next question comes from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah, thank you for the question, sir. Am I audible? Hello?
Yeah.
Hello? Yes, sir. So first of all, very happy to see the disclosure levels regarding the bifurcation of revenue, the slide 17 which you mentioned. So my question is on the spec chem side. So just to cross-check, so the EBITDA margin which you have done in the spec chem for Q2 is 8.6%. Is the calculation right?
Yes, you are correct.
Okay, fine. So now, so we did 950 crore last year in Spec Chem, and with this, the new product which is mapped, so will you be able to, make up for the loss and end on a flat note for Spec Chem for FY26?
So Dhaval, the way we are steering this business, because one needs to be always a little bit cautious about looking at a quarter in lens. What we have done, and even if you have seen our past performance, we have been in our specialty vertical anywhere between the 20 to 25%. So in FY25 we handled at about 24% of EBITDA. In FY24 we were at 23-24%. So I think it's a point in time story. Clearly the focus remains already into the second half, that we are improving the chug rate, coming closer to where we have landed in the past. And more importantly, with the Dahej capacity coming up, we will be globally number 3 with the diketene derivatives, and that is something we will continue to leverage upon with the clear focus that we are in that zone. That's what we will work very diligently to land into.
Got it. And sir, could you just reiterate the timelines for various projects which are coming on stream?
Sorry, can you just repeat that, Dhaval?
So the timelines for the projects which are coming on stream, the Dahej and the expansion which we are doing in the
So I understood your question. First is the fluorination project which is happening in Lote. That is already has taken good shape, and we are ramping up. So FY26 is the first year of ramp up, and as I called out, we anticipate to be closer to the 40 to 50% of the peak revenues in this financial year for that project. What else is happening at our Lote facility is the Hitachi collaboration, the Vayu. Given that we have the contract now signed, done and dusted, we are also in a capex execution mode there, and we expect that plant to come up by Q2 of the next financial year. And what will also happen at our Lote facility is our world scale ethyl acetate, which we have called out, which should come up by Q4 of this financial year. If you look at changing gears at our Dahej facility, the phase 1 has come online, the C2 has been achieved, and we are already starting to supply customers from there. This first phase of investment is actually backed by a long-term supply agreement with one key large customer who has a downstream complex in Gujarat. And the phase 2 is anticipated to be mechanically completed by Q4 of this financial year.
Okay. Noted, sir. And anything you would like to share regarding the semiconductor product which we are working upon under our fluorination, electrochemical fluorination chemistry?
Still early days. I think we are taking good shape. The electrochemical fluorination as a technology platform has started firing for us, and I think that is what I would like to park it with. And over the next quarters, we will continue to build our strength into that.
Got it. Okay. And sir, what were the spreads for the quarter you would like to share?
The spreads were not too different from what we had experienced in the Q1. So I think it was similarly in that ballpark. So as I was calling it out, bottom of the bottoms, somewhere in that range of $90 to $100, specifically for ethyl acetate.
Got it, sir. Thank you. Good luck.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Manish Bhadane from B&K Securities.
Thank you so much, sir, for the opportunity. So if I look at your presentation, you have given the export revenue breakup. So in that, if I see that in the Europe, it contributed around the 23% in the first half of FY25, and now it's around the 31%. So are you seeing any sort of demand coming from the Europe?
So again, Manish, thank you for that question. So first and foremost, like we have also shared in the past, Europe as an area is going through a lot of change. So in my opening commentary, when I talked about shutdowns and restructuring, wherein we have seen structurally, I would say subscale or non-competitive assets. A lot of that is happening in Europe. I would say we are double-clicking our capability in Europe because we already have tank operations in Antwerp and Genova for our key products like ethyl acetate. I would not say we are seeing a rebound. Let me keep it in perspective. If you see this chart, we are seeing maybe certain other geographies where our exposure has slightly reduced from a point-in-time lens, and that is where you are seeing the European pie being slightly larger. But that being said, our focus remains to expand our presence in Europe.
Got it. Thanks.
Thank you. The next question comes from the line of Nitesh Dhoot from Anand Rathi Institutional Equity. Please go ahead.
Thank you so much for the opportunity. Sir, so my first question is on the fluorochemical revenues. So you've indicated that it's likely to be about 80 odd crores in FY26. Would it be possible to share how much have we done in H1 so far?
So Ritesh, at this point of time, the focus still remains exactly like you called out. We want to land up close to about 80 crores. I think you want to give some flavor on that one. At this point of time, we don't break it down. We are gradually ramping up, but we have a great line of sight to be at that 80 crores that we have lined up for this financial year.
All right. So no change to the outlook, right?
Change to the outlook for the FY26.
Sure. So second one is on the capex figure. So H1, if I look at the capitalization number is about 300 odd crores. The commercialization that is. So presentation says that you commissioned the acetaldehyde plant. I missed your initial comments on the capex. So what else did you commission in H1? Can you give the breakup there?
So part of the Lote plant also got capitalized in Q1. And in Q2, we capitalized the acetaldehyde plant in the H.
Oh, sure. And can you give the breakup? I mean, the amount? I mean, how much was it for acetaldehyde?
10 crores.
All right. So just the last one on the Hitachi project. I mean, any update there on the on the proposed capacity? By when is it likely to commission?
So we stand with what we had communicated in the past. This is a 60 metric ton capacity that we are setting up. Capex is 75 crores, and mechanical completion is anticipated by Q2 of the next financial year.
All right. Okay, so thank you so much for answering my questions. Wish you all the best.
Thank you. The next question comes from the line of Harsh Shah from Axis Capital. Please go ahead.
Hi sir. Thanks for the opportunity. Sir, you mentioned that you have already started supplying to one of the customers from the phase 1 of the Dahej plant. So just wanted to know what kind of commitment you have, what portion of the capacity is already tied up with that customer. That is my first question.
So Harsh, we have a multi-year contract with the customer, and the majority of the capacity has been lined up contractually with that customer.
All right, sir. All right. And the second question on the essentials volumes. So in this quarter, basically the commentary which Mahadev gave, the essential volumes are largely steady. So have we reached the full capacity utilization there, or there's still headroom to increase the volumes from the existing capacity?
So Harsh, if you have been sort of tracking us, we've been diligently building on our operational excellence journey, churning out more from our existing asset base. And I think that remains the key focus. While we've seen big jumps in the previous years, we are at this point where you will not see double-digit jumps, but we will continue to sort of juice out our assets because we believe we are in a good cost position, and that is what we are leveraging. Then the other lens is the new capacity which is coming up, which is ascribed to our essentials business the phase 1 at the H. And also, as I called out, the world-scale ethyl acetate, which should be, mechanically complete by quarter 4 of this financial year. That would all aid us into the next financial year.
All right, sir. All right. And sir, just to follow up on the first question. So, the contract which you have signed with the customer, so is there a step-up arrangement or the volumes are evenly distributed across years?
Can you just repeat your question, Harsh?
So the long-term contract which you have signed with the customer, so there is a step-up arrangement, so volumes will gradually increase over the years, or they are evenly distributed across that contract tenure?
It will gradually increase, but the customer has already set up his manufacturing facility, so that's why it's a good timing.
All right, sir. All right. That's all from my side, sir. Thank you, sir.
Thank you.
Thank you. The next question comes from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Thanks for the opportunity. First question is on the incentive. So on slide 25, we have given the bifurcated adjusted EBITDA. But if I look at the reported numbers, it seems that there is no line item below the EBITDA which has this incentive income. So how there is a difference between the reported 371 million EBITDA and over and above that incentive income coming?
So let me clarify. In the GST incentive is part of 371 EBITDA. As we are eligible for this site, the incentive as per Maharashtra government's incentive scheme, we have considered it as a sales and revenue from operations.
So just clarification, there is another number.
I'm sorry to interrupt you, Mr. Rohit, but can you please use a handset while speaking?
Yeah. Yeah. So there is another element, 23 million, which is there. So what is that for then?
So that's the GST incentive, 23 million. That
so out of
the number. Yeah.
Okay, sure. Thanks for the clarification. Second question is in terms of the capex plan. So out of the total 1,100 crores, where are we currently, and how are we planning in terms of FY26 and FY27 capex number? And what are the timelines for each of the projects for commissioning?
So I think the midpoint of expenditure on the capex is going to happen in this financial year, Rohit. As I called out, the startup timelines, phase 1 at the H has already happened, as we called it out. The phase 2 of the H mechanical completion is anticipated by quarter 4 of this financial year. At our Lote facility, basically it's a ramp up that is happening. The world-scale ethyl acetate is anticipated mechanical completion in quarter 4 of this financial year. And for the Vayu project, which is the partnership with Hitachi, basically the capex execution has started, and we are anticipating by quarter 2 of the next financial year mechanical completion for this year.
Sure. It means that for by FY26 end, we will have about 550 crores of the capex completed. And then FY27 and 28, the rest of the 550 crores will come in. Is that assumption right?
As per my estimate, it should be around 800 crores capitalization by FY26, and rest should happen in FY27.
A big chunk of the capex, Rohit, is for the Dahej facility, and since that is going to get mechanical completed by quarter 4, so that's where a majority of the capex is being focused upon.
Perfect. That's all from my side. Thanks a lot and all the best.
Thank you. The next question comes from the line of Arthur from ICICI Prudential Mutual Fund. Please go ahead.
Yeah, so just wanted to check the incentive which you mentioned is basically any period that you can highlight. So what period will be eligible for that?
So it is as per the incentive scheme of the government, so it's for the earlier periods. That is what I can disclose currently.
No, so basically next quarter onwards there will be no similar kind of
No,
because it is traffic.
So it's an yearly affair. We will have to apply yearly to the government, and then we get those incentives. So it will not be quarterly, but for sure yearly.
But Atul, to your point, the majority has got baked in quarter two, if that's the direction of your question.
Got it. Thank you.
Thank you. The next question comes from the line of Yash Mehta from Malabar Investments. Please go ahead.
Thanks, team, for the opportunity. I had one clarification on the incentive side. The number is 234 million, which is the GST incentive, but the EBITDA for that is 23. I am trying to understand why is there such a large drop between what is coming in as incentive and what is getting recognized as EBITDA, because I would believe this is an additional line item that drops directly to the EBITDA.
Let me clarify, Yash. We have not. We have kept that in income from operation, the GST, which is 234. So it flows down to adjusted EBITDA. What you are seeing at 23, that's a one-time expenditure of the Symphony project. That is there in quarter two. So though the numbers are 23 and 234, that's why I think there is some confusion. Let me again clarify. 234 is part of our operating P&L.
Okay, and 23 is, sorry, if you can repeat what that is.
23 was the Symphony project for the supply chain transformation that we are getting into, which we have incurred for this quarter.
Got it. No, I understood.
Previous quarter also gets called out here. Yeah, that was.
Fair. And sir, the other is the 230 crore specialty revenue in last year in 2Q FY25, which is today 183. One element of the bridge there is that almost 10% of the revenues were impacted because of the agrochemical products being phased out, which is a one-time number. Here there are 2-3 other moving parts. So you would have included the GST incentive of 23-24 crores in the specialty revenue. That kind of takes care of the drop. But the additional drop is coming despite the increase in fluorine chemical project. I'm trying to understand the bridge in the fall and what all factors have influenced the decline.
So I think, yes, it's a specific, very granular question. We are happy to clarify that. Why don't we take this as a follow-up, and then we can sort of get into that level of granularity that you are seeking. Let me just again clarify, apart from what you called out, the agrochemical phase-out, there are two other elements, that is the deferred deliveries, which we also called out in quarter one, which will now happen in the quarter between quarter three, quarter four of this financial year. And also, is the market price moderation that we have also seen to a certain extent in our specialty portfolio, given that feedstock prices have significantly reduced.
Got it. So the factors that are so the question is, the factors that are affecting larger part of the decline seem to be one time related to this quarter rather than the next 2 quarters.
Yeah, apart from the agro, which is the one-off, the other thing on the market price moderation, I think that will accompany us depending on how the feedstocks are developing. But the deferred delivery is something which will recover in the second half.
All right, sir. And just to clarify, I'll take that offline, but just 2 clarifications on the specialty revenue number, sir. One is that the fluorine ramp up, which is like 20 crores per quarter, that would be kind of built into the specialty revenue, and you will have the GST incentive also built into the specialty revenue. Is that a fair assumption?
You are correct, but we will share with you the quantity.
All right. And one last question, sir. If you divide the EBITDA of, if I missed the opening remarks, if you can just help me with the EBITDA for essentials and specialty business.
So EBITDA for essential business is that's 1%. Sorry, 2%, and for specialty it is 8.2% for the quarter.
8.2. Okay, thank you.
Thank you. The next question comes from the line of Darshan Garg from Tiger Assets Private Limited. Please go ahead. Mr. Darshan, you're not audible. Please go ahead.
Hello, am I audible?
So your voice sounds muffled. Can you please speak through a handset?
Yes, sure. Hello, sir. Am I audible?
Yes, you're audible now.
Sir, wanted to know related to the SF6 replacement. So, what is the opportunity size for us?
Darshan, thanks for the question. Let me just call out what we have stated. Fundamentally, the first wave is 60 metric tons that we will be establishing. That is the alternative for the SF6. The capex for that is 75 crores, and this asset should be operational by mechanically complete by Q2 of the next financial. Discussing with customers, we do see this as an interesting opportunity to support their growth, and Hitachi is our current partner and the primary partner in this journey. The technology is very much Laxmi's technology, so there is no exclusivity, and we can continue to also grow this. That's the way we would view it, Darshan. At this point of time, happy to take up specifics thereafter.
So do you have any prox number in your mind for the Porsche?
Yes, we do, but I think it will also depend on how. Certainly, we see this as one of our growth engines, also moving ahead. But at this point of time, we are very much led by what the customers are saying and how this would kick in. We certainly see the regulatory framework in different regions also being a catalyst in this change.
Okay, fair enough. Secondly, sir, since most of the SF6 replacement materials are imported from China, so what is the price difference between our domestically produced material and the imported one?
So at this point of time, we are, as we called out, right? We partnered with Hitachi, and we are basically serving Hitachi's requirements outside of India. So this is not a domestic play. We will certainly support Hitachi. In fact, with our announcement, Hitachi has also succeeded in getting its first order for the iconic grade from Power Grid domestically. But a big chunk of the volumes that is being discussed with them are for the export markets.
Okay, fair enough, sir. Thank you for the opportunity.
Thank you.
Thank you. The next question comes from the line of Saumil Shah from Paras Investments. Please go ahead.
Yeah, hi, sir. So I would like to know what is our current capacity utilization for specialty, essentials, and fluorochem, if you can bifurcate and give us.
So the reason why we are expanding our capacity in all is because we are very well utilized, Saumil. So our utilization, as we have been calling it out for our essentials business, has been upward of 90 to 95%. And that is where the expansions are happening in our essentials basket, in our specialty baskets, in the diketene derivatives. Also, we are fully utilized, and hence we are doubling our capability, and we will be then globally top 3 producers of the ketene diketene derivatives. And our fluorination we are ramping up, so we still have a journey to traverse there. Fundamentally, in the course of this financial year, we want to be closer to about 40 to 50% of the peak revenues that we are able to get out from that asset base.
Mm-hmm. So, sir, if we are saying that in essentials we are about 90 to 95% utilization, then why are we not able to increase our EBITDAs? I mean, if we are at full capacity, isn't it possible to increase the EBITDA margins?
So I think there's a correlation is also linked to specific margin. So if you look at the spreads, right, it's not simply me pushing more volumes. If you to think about it the other way around, if I had capped my capacity as say 100,000 tons, and if the margin spreads had come down, in fact I would have been facing a much lower overall EBITDA realization. The fact that with our operational excellence journey, we have been able to churn more from our existing setup, and also given our cost position, we are able to place these products competitively in the market, is where we are leveraging both this value and volume. So that's the game we are playing, and you will certainly see it playing this out. So, while we are talking a point in time, if you look back at history, where the spreads have been higher, then we have been able to leverage that. When today the spreads are lower, we are very clear we are in the top quartile in the cost curve, and that is what we are leveraging.
Okay. So is it fair to assume that once the capacity increases, the essentials margins can also go up?
It will not be only margin story. It is the consolidated, what we would say consolidated CCM1. So it is the specific margin multiplied by my volume. So as my throughput in my volumes into the market increases, then my consolidated margin will certainly increase.
Okay. And so if we are to look at our fluorochem business, so as we have guided 40 to 60% of peak revenues, so that is about 100 crores for this year, and maybe 200 crores for next year. So isn't this too less? I mean, too minuscule compared to our total revenues? So are we not planning to expand this fluorochem business?
So, Saumil, your question is spot on, but, again, just dialing back, right? What we have always said is we acquired that asset for its technology. And we said that asset that we acquired will be only able to generate up to this 200 crores of revenue. And this is also what was in the ballpark of peak revenues that the previous owner of this asset was able to generate based on their product mix. So you are correct. If you then see the follow-up we have done, the partnership with Hitachi and the investment, and we certainly have plans thereafter to also, over a period of time, expand our fluorination vertical. So you're correct in saying 200 is minuscule as compared to the larger piece, but ambition remains much larger also in fluorination for us, building on our first successes.
Because honestly, as a shareholder, everyone were too gung-ho when when we had guided that we are entering into fluorochem business. But I think since last 2, 3, 4 years also, we are still targeting 200 crores by FY27. So just from the shareholder perspective, I was asking this.
No, fair enough, Saumil, and it is a fair ask, and I think it's a correct ask. But we have also been very, very transparent, Saumil, how that journey has traversed, what have been our reflection, and most importantly, today we are coming out of that journey and looking certainly forward for growth. And the testimony with the Hitachi partnership is one such success that we have garnered.
Okay, so any more capex for fluorochem would be post FY27. Nothing in next 1.5 years.
Apart from the one we have just called out for the SF6 replacement, which we have been now basically by being prudent in the capex layout, we are able to accommodate that. Any expansion, we will come back to the street with clarity, but my primary focus and my management team's focus is we are spending capex here and now, and we want to leverage that capex and deliver growth for our shareholders and customers.
Okay. So this Hitachi revenue, whatever we are saying, would be within this 200 crores? Or it would be over and above?
This will be on top of that.
And so we are not guiding anything on the revenue front. What could be that number?
So we have said, again, the capex is about 75 crores and asset turn is about 1.2.
Okay, fine. Thank you, and that's it from my side.
Yeah.
Thank you. As there are no further questions, I now hand the call over to the management for closing remarks.
Thank you again. Thank you all for investing your time with Laxmi Organic. Let me just again conclude with my reflections, repeating some of the elements that I started with. The global chemical industry backdrop remains very demanding, and this is shaped by regional dynamics given the overall supply side overcapacities.
On behalf
the industry continues to be marked by targeted efforts towards cost optimization and restructuring of structurally subscale and non-competitive assets. We spoke about the demand signals from our customers and key segments. We spoke about the specialities, the performance into quarter two, and how we are also lining up, especially if you talk about specialities into quarter three. The success we've had with the fluorination setup and also with our roadmap at the new capex at the H facility. I would say with the demanding global chemical industry backdrop, as Laxmi, we continue our focus on productivity, commercial excellence, execution excellence, cost discipline, and you saw that in the numbers when Mahadev explained it, and growth projects. Cash flow from operations is a very important metric that we are steering, and there we have also done very positively as compared to the similar time previous year. So as Team Laxmi, we remain geared to win and geared for growth, and I remain deeply grateful to all members of Team Laxmi and its stakeholders for their continued engagement. Thank you.
On behalf of Laxmi Organic Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.